Joined by Dr. Iman Nasseri, Managing Director at Middle East FGE NexantECA, now joining us. Mr. Nasseri, thank you so much for taking your time out and joining us here on ET Now. Brent crude prices have now corrected to below $80 per barrel, and that's a significant 30% correction from the recent highs, isn't it? How much of a geopolitical premium, in your opinion, has already been priced out? And is the energy market already assuming that the US-Iran interim peace agreement is perhaps sustainable for some more time?
Yes, Shasha, thank you so much for having me on your show. As you rightly mentioned, the market has jumped the gun and basically went ahead of themselves in terms of assuming that everything is all right. There is no deal yet signed. There is an MOU, which is basically the common grounds of understanding between the two parties. And let's remind ourselves that there have been many, many MOUs signed in the commercial world between the governments, between the companies, which never yielded an agreement at the end. So this was just basically signing something that gives them more time to discuss towards a deal, which is still is hard to imagine to be achieved within 60 days. In fact, I doubt that within 6 months we have anything solid between the two countries. And remember, this MOU basically has two main ingredients. One is opening and reopening the Strait of Hormuz, which both parties agreed to remove their blockade for the shipping industry to go through. But there is another important element into this MOU, and that's basically the peace on all fronts, including Lebanon, which has two other parties, Hezbollah and Israel, involved, none of which have been part of this negotiation. And so it is a fragile MOU in itself, but to ensure a very smooth transition by the oil market players through the Strait of Hormuz, it's a bit too early. And yes, the prices dropped to $77, $78. This morning, they are back above $80. And that's basically because the parties, Iran and the US, said that perhaps they're not meeting in Geneva to sign. And that's basically the first sign that things are not fully resolved. Again, I think the market and both sides were a bit kind of desperate to get more oil and energy into the market, but there are a lot of uncertainties and lack of understanding in many other grounds which were not included in this MOU that need to be ironed out, and that's the key thing that market has to watch, and we continue to monitor how these two countries and if they ever get closer in their disagreements.
Clearly, we are seeing signs that everything in West Asia is not resolved. In that case, Mr. Nasseri, do you think that this geopolitical uncertainty will continue to drive oil markets, at least in the near term, and perhaps oil market will not be driven more by economics and less by geopolitics?
Definitely. The market has been basically disconnected from fundamentals. The prices that we have witnessed over the past 3-4 months have been far from what the supply and demand suggest. And in fact, we saw prices in excess of $120 for Brent and $160, $70 for Middle Eastern crude, and product prices in excess of $200. That was all including a huge premium for geopolitics, for war, but also to pricing, basically pricing to phase out demand and kill demand to match the very constrained supply of energy. Going forward, I do expect to see these ups and downs and volatility as the market adjusts to this new norm that one day they are positively talking about a potential deal, and the other day it looks distant. And remember, the shipping industry, the trading community will not act on the announcements and basically MOUs signed. They act based on very strong, solid security, safety, and compliance that their companies and governments require for them to trade, to make payments. And that is still not there. I don't think we are going to have a very clear roadmap for the payments, for the shipping insurance, and in fact, the risk of further escalation and attacks. Remember, many companies basically made huge losses by having their vessels stranded in the Strait of Hormuz, by having their cargoes sitting on water idle for 3 or more months. And that is a risk they will carry forward as long as the MOU, which is a fragile preceding to an agreement, is not fruited into a full, solid, permanent agreement.
Given everything that we are seeing on the geopolitical front, Mr. Nasseri, what do you think is the fundamental fair value of oil prices at this point in time, keeping geopolitics aside, but given the demand fundamentals that we are seeing at this point?
Yeah, that's a good question. Right now, with the Strait of Hormuz, at least for now, temporarily open, and a lot of stranded cargoes, loaded vessels rushing towards the market, and in some way you could call this actually an oversupplied market, because all the oil that is going to be placed into the market were not part of the equation, were not part of the supply, demand, and trading cycle of market players over the past 1 to 2 months. The market is going to be at around $70-$75. That's the fair value today based on fundamentals. But then going forward, again, depending on how we see demand evolving and basically reaction to what we are going to see over the next 1 or 2 weeks, we expect the prices to sit in $75 to $80 in a fair value. Anything above that is basically risk premium, and I don't expect we see anything less than $70-$75 in the absence of a very solid and permanent deal.
Okay, so $75 to $80 per barrel is the fair value, and anything above that is the risk premium on account of geopolitical concerns. But let's hypothetically assume that the deal stays effective. In that case, how soon, in your opinion, will the passage through the Strait of Hormuz normalize?
Yeah, that's a good question. I think, again, we need, if we assume a deal is signed, and if we assume that everything is as solid and permanent as the cargo owners, the ship owners would hope, to let their internal policies, whether it's commercial within organization or it's countries and European Union, European countries, everyone to act on it and remove their compliance constraints and payment terms are discussed and said, then the flows can normalize rather quickly, perhaps in a month or so. But remember, we don't expect the flows to go back to pre-war level in any time soon. And 2 main reasons contribute to that. One is that there have been diversions of oil in Saudi Arabia and the UAE through their pipelines to Red Sea and to Fujairah. Those probably will stay there for much longer, if not forever, just to reduce the risk of supply through the Strait of Hormuz. And the second is that we have had casualties and damages on certain refineries and LNG plants, that those barrels and LNG cargoes will remain out of the market for at least a year, if not longer. So the supply can come back rather quickly if everyone, and certainly key Western players that have been lifting cargoes from the Persian Gulf, assume that it's safe and it's also, they remove their compliance barriers, then within a month, we could go back to 80-85% of pre-war flows.
Okay, so oil supply can normalize very quickly if the deal remains in place for some more time. That's the word coming in. But what will the base case price estimate be for oil for the remaining months of this year? And where do you expect oil to trade at the end of this calendar year, assuming that the situation remains status quo as we are at this point in time?
As I mentioned, we had just this MOU signed a day or two ago. In fact, the actual signing ceremony, which was supposed to be today, is now postponed. So we are far from certainty. And in an uncertain forward 6 months, what we have done is that we have taken a risked view. We have not included a full resumption of the flows and full return of supply in our balances. Hence, what we see is that only 50 to 70% of pre-war flows within the next 6 months in sight. And with that sort of still constrained supply, we could expect prices of $75 to $85 during the next 6 months based on the fundamentals, based on the seasonality of demand. So higher prices probably in the next few months of summer peak demand season, and then maybe slightly lower prices as we head towards third quarter and fourth quarter, with the flows in our assumption, our base case, recovering towards 70% or so, and then demand in at least in the third quarter, in the fourth quarter, slightly lower.
Okay, so oil prices could remain in that range to $75 to $85 per barrel. That's the word coming in. Let's also talk about OPEC Plus. They have increased output quota in the month of July for the fourth consecutive month. How, in your opinion, is OPEC Plus likely to respond if prices continue to sustain below that $80 per barrel mark, which we are seeing currently?
I think OPEC Plus is not responding to prices so rapidly, if at all, unless we see prices in basically very excessively low or high prices, and for sustained period. We saw even high prices of $120 or more in March, second half March and April, which didn't trigger OPEC Plus to react, and they continue to act normally because what they see, what they require to see before they act is a sustained level of oversupply or undersupply. And for them, that is only proven, as they say, when we see it, which means that the numbers should come, the numbers from the countries that report to IEA and OPEC should come and show them that the market is in a structural oversupply or deficit, which I don't think we're going to see that kind of market environment over the next 6 months. So I do not expect any major announcement from Vienna over the next 6 months. However, if everything moves towards normalization, if we see a deal emerging within the next 6 weeks, 8 weeks, or in fact 8 months, with then demand recovery and supply normalization from the Persian Gulf, we may end up in an oversupplied 2027. And that means OPEC Plus may, if the numbers prove that structural oversupplied 2027 to them by the end of the year, or in fact first quarter next year, they may decide to revise their pact and basically reintroduce another batch of cuts. But that's far from today, and there are a lot of moving parameters before we get there.
Clearly, several moving parts globally, but beyond geopolitics, which is currently hindering global oil market, let's also talk about demand then. How is demand shaping up? And are we seeing any signs of demand weakness, whether it is from China, Europe, or the US?
Well, demand has fallen. Demand has been one of the key factors solving the market and balancing the market over the past 3 months. The demand adjustment has been in three tranches. Basically, the Chinese who were basically consistently buying crude oil for their SPR strategic inventory building, they stopped buying. That kind of was the first demand adjustment down. The second was all the demand that had to curtailed because of lack of supply. Especially, we're talking about petrochemical sector in Asia that used to import 2 million barrels per day of LPG and naphtha from Middle East. They had to shut in capacity, and basically that was a big demand adjustment downward. And the third the tranche of demand destruction was price driven, meaning that the prices at pump for gasoline and diesel went through the roof, and consumers adjusted their demand. We find basically at its peak around 4 to 5 million barrels of demand was destructed in April and May, and maybe from that 10 to 20% maximum were price adjustment. The rest were either lack of supply or regulation. Certain countries came up with quotas. As we go forward, a significant amount of this demand will come back, especially when there is more feedstocks for petrochemical. They are going to start basically procuring and running. With prices now back into, let's say, $70 to $80 range, consumer behavior will adjust. And the only part which is questionable is how China is going to go back into buying mode, especially for two purposes: building inventories and also exporting products, which also were stopped, and there was a ban on exports. So the only questionable and sizable demand adjusting going forward is Chinese buying behavior.
Okay, all eyes will be on Chinese buying. We've seen some bit of demand destruction over the last few months, but that is likely to come back on stream. That's the word coming in. Mr. Nasseri, thank you so much for taking your time out and joining us at a time like this when oil market is in focus, especially for a country like India, which relies heavily on imported crude oil. Thank you for taking your time out and joining us here today.
Thank you.
On that note, we need to slip into a very short break, but more news and updates will continue on the other side.